So today we'll be discussing about gains and losses from sale of long-term business property. You have to file Form 4797 for that under IRS. So first of all, let's understand the three types of assets that may be held by a business or corporation. So, first one is the ordinary income assets. Ordinary income assets are for the current assets of business. So, the assets which are acquired or produced with the intention of being sold in the ordinary course of business, which may include inventory. So it will be including the inventory or accounts receivable or any self-created artistic work. So then we have no special tax rules or limits for ordinary income through sale of long-term business property, and the gains and losses arising from maybe the sale of self-created patent, inventions, model or design, so or the maybe the secret formula or process. These all are treated as ordinary income. So basically, inventory, accounts receivable, and you can say the intangibles. So intangibles also comes in. Then there is section 1231 assets. Basically, these are for non-current business assets, assets comprising principally personal and real properties. So section 1231 is for personal and real properties. And these should be used in trade or business and held for over 12 months, whose eventual sale or disposal is only incidental to the business. So mainly it will include, for example, equipments. So equipments will be there in this. So yeah, and then these include basically the depreciable assets and land. So land is not a depreciable asset, but it is included in section 1231 assets. So basically all the plant uh, properties and equipments. So these are those which are, if like they are held for over 1 year, then uh, net gain is long-term capital gain and net loss is ordinary loss. So these are the like best of both worlds. So best of both worlds. So you're getting a gain as a long-term capital gain and loss as an ordinary loss. Then, if these assets are held for less than or equal to 1 year, then you will be treating it as an ordinary gain. And these conditions are subject to these two assets, 1245 and 124 or 1250. So subject to these two assets, and this 291 is basically for corporations. We will discuss it later. So section 1250 1245 are certain conditions which should be met before we consider section 1231 assets. So we'll discuss it in detail. Let's first discuss the capital assets. So capital assets include investments and non-business assets. So all assets that do not qualify as ordinary income or section 1231 assets are qualified for capital assets, which may include investments, assets for personal use, like by individuals, or goodwill. So goodwill is also there. So plus goodwill is also there. Then these are treated as capital gains and capital losses. So any gain or loss from sale of capital assets are treated as capital gain or loss. So these are capital gain or loss. Then the tax classification. So you should be aware that the tax classification of an asset depends on how the asset is held by the taxpayer. So, for example, car is an ordinary income asset for if it may be an inventory to a automobile manufacturer, so he will treat it as the ordinary income. And if it is like a section 1231 asset, maybe to a corporation who bought the car for business use, so it will be treated as a section 1231 asset. And it may be treated as a capital asset if an individual bought the car for personal use. So it depends upon the usage, the way the asset is being held by the taxpayer, which uh, categorizes the asset into ordinary income asset, section 1231 asset, or capital assets. So ordinary income assets, basically the sale of ordinary income assets are generally are all obviously the ordinary income. Section 1231 will discuss it in detail in a meanwhile. Then capital assets all are the capital gain and losses. So now we come back to section 1231 capital 1231 assets. So 1231 assets are generally comprises of principally comprises of personal and real properties. So personal and real properties used in trade that we discussed, or business, used in trade or business, and held for more than 12 months, whose eventual sale or disposal is only incidental to the business. Now, gain or loss on section 1231 assets are calculated on sale, exchange, or involuntary conversion, like condemnation or fire. So, there is we talk about that best of both worlds. Like net gain is a long-term capital gain, and net loss is an ordinary loss. So capital gain treatment for section 1231, it allows to like a tax rate of 0 to 20% on net section 1231 gains, subject to again 1245 and 12450. Then ordinary loss treatment, section 1231 losses are netted against section 1231 gains. However, Section 1231 losses in excess of Section 1231 gains. So, if Section 1231 loss is more than Section 1231 gains, so any excess are treated as ordinary loss, which has the advantage of full deduction immediately without consideration for capital gains. So you no need to carry over the undeducted loss to other years. However, for corporation, capital losses may be deducted only to the extent of the capital gain, and balance may carry back 3 years or carry forward 5 years. Then for individuals, it is $3,000 deduction for capital loss over and above the capital gain is allowed, and balance may be carry forward indefinitely. So if property held for less than 12 months, gains and losses or gains or losses on sale are treated as ordinary gain and losses. Now let's talk about section 1 to 4, 5 assets. So section 1, 2, 4, 5 assets. So section 1, 2, 4, 5 asset is about it comprises of personal property. So section 1245 is about personal property, and section 1250 is about real property. And by personal property, we mean the property, movable properties like machines and equipments. So it will include machines and equipments used in trade and held for more than 12 months. So, section 1245 gains are considered as ordinary gains, and these are the recapture recapturing of all accumulated depreciation. So, recapturing of all accumulated depreciation means a lesser of gain realized or all accumulated depreciation. So, we have to see after a sale whether we first identify the accumulated depreciation, and then we'll identify the gain realized, and compare the two. Whatever is the lesser will be known as the recaptured all the accumulated depreciation and considered as section 1245 asset gain, and considered as ordinary gain instead of section 1231 capital gain. So if there is, so for section 12450, if we have to find the recapture of accumulated depreciation wherein lesser of gain realized and or accumulated depreciation will be considered as is equal to section 1245 depreciation. Depreciation 1245 gain or loss. Gain or loss. Now, if we talk about section 1250, that is real property, example building. So again, building use in trade and more than 12 months, held for more than 12 months. So Section 1250 gains again are considered as ordinary gain, and recaptured gain is calculated as only the portion of depreciation taken on real property that is in excess of straight line method depreciation. So anything for this, anything straight line SLM method and depreciation calculated. So depreciation minus SLM will be equal to 1250 SL or gain. So 1250 gain, then it applies only to assets placed into service under the old accelerated methods of depreciation for real property, as the current rules require straight line depreciation for real property. Then excess gain again is the section 1231 capital gain in both the cases, in 1245 and 12450. If there is any excess gain, then this section 1245 or uh, section 1250 gain, it will be considered as section 1231 capital gain. Any section 1245 or 1250 loss is considered as section 1231 loss, that is the ordinary loss. So there is no condition for loss, there is just condition for gain. Then whatever the unrecaptured gain is there in section 1250 assets to the extent of straight line depreciation. So the only the amount left, the straight line depreciation is taxed at maximum rate of 25% of individual for individual. So, for example, let's take one example over here. Let's say there is one personal property. Personal property buy at 100, depreciation at $30, and base. So the basis is $70, and let's say selling at $120. So in this section 1245 gain will be uh, $30. So the amount, the recapture of all the accumulated depreciation. Why? Because the realized gain, so here realized gain is $50, that is 120 minus $70, and depreciation is $30. So we will take lower of the two as a 1245 gain. So 1245 gain or ordinary gain in this scenario is $30, which will be taxed at the individual tax return taxpayers slab rate, and rest will be 1231 gain out of $50 of gain. So $20 will be capital gain. Capital gain. So this is how we calculate the section 1245 gains, and since it is a personal property, we are calculating the 1245 gains. Now, what if it is a real property? Let's take that example as well. So, if let's say it is a real property, this not a personal property but a real one. So if this is a real property, we have to consider 1250 assets. So let's say buying at $1,000, depreciate at $90, let's say. So basis is $910 and selling it at $1,400. Now, assume that straight line method is, let's say, $60. So, under this method, 1250 gain will be the excess of SLM, excess of depreciation over SLM. So, depreciation is $90 and SLM is $60. So, 1250 gain will be 90 minus 60, $30, which will be considered as ordinary gain. Then, so this is the recaptured gain. We have recaptured it. Then we have unrecaptured gain, which is taxed at 25%. So unrecaptured gain will be unrecaptured 1250 gain will be the remaining this SLM part, that is $60, which will be taxed at 25%. Then the remaining we have 1400 minus this 910, 1400 minus 1000 of the buy. So we are left with $400. So this $400 will be considered as 1231 gain. So total of 490, 400, 60 and 30. Total is 490 and this 1400 minus 910, 490. 490 is divided into 3, 1250, unrecaptured 1250 and 1231. This is 1231 gain. So this is how we solve personal property and real property. Now, personal property, as we see in a gist, if we talk about summary of personal and real property or 1245 and 1250 property. So, ordinary gain is section 1245 and 1250 are considered as ordinary gain. In terms of section 1250, the recaptured one is considered as the ordinary gain, which is the difference between the depreciation and SLM method. Then 1231 capital gain is considered as the capital gain, the remaining gain, which is after accounting for section 1245 and 1250. That are the ordinary gains. Then unrecaptured section 1250 gain is the remaining straight line depreciation, which is taxed at maximum rate of 25% for individuals. Then all the losses are considered as section 1231 losses, and they are first net against section 1231 capital gain, and the remainder is treated as an ordinary loss. Now, for C corporation, lower capital gain rates do not apply like the section 1231, and all capital gains of a C corporation are taxed at ordinary income tax rates. The only benefit of capital gain is that these can be used to offset any capital losses. Else, the capital losses would not be deductible, and any non-deductible capital losses for the year are only allowed a 3-year carry back and 5-year carry forward. Now, C corporation do not have the unrecaptured section 125 tax 1250 tax rate, but rather an additional section 291 assets recapture when depreciable real property is sold at a gain. So under section 291, which is recapture and which is only for C corporation, uh, it applies to section 1250 assets that are the depreciable real property which are sold at a gain. And as per section 291, recapture 20% of the lesser of recognized gain or accumulated straight line depreciation as an ordinary gain. So 20% of lesser of the recognized gain of the accumulated straight line depreciation as an ordinary gain. Now, we'll just see how these are calculated. So let's take one case study. Let's start with one case study, which is this. So Hercules, who is 33% tax bracket, who's in 33% tax bracket, is would like is like sold the following assets during the year. All these were business assets held for over 12 months, so they are qualifying for 1231 assets. Now, different costs, accumulated depreciation, and selling prices given to us. Now we have to first calculate. We have to calculate 1245, 1250, and 1231 gain. So for that, let's first let's first calculate the recognized gain or loss. So for that, first of all, we will be calculating the net book value. So net book value will be cost minus accumulated depreciation. So 1300, 9800, 18 minus 12, 6000, and $14,000. This is the SLM method given. So we'll see how to do that. Now, net book value are these, and we have selling price are given. So the recognized gain or loss, recognized gain or loss will be uh, 1200, that is 2500 minus 1300, 12,000 minus 9,800, 2,200 minus 2,000 and 9,000. Now, once we calculated this, now we have to calculate section 1245 and section 1250 gains. So, over here, this is office equipment and machinery are the personal assets. So, these will be considered as section 1245. So section 1245. So in this, the gain part, the depreciation part, that is $900, and so $900 will be considered as section 1245 gain in this. So this $900 is section 1245, and remaining will be 1231 gain. Then, if we talk about machinery, in machinery, we again take accumulated depreciation or realized gain, whichever is low. So we will be taking 2,200. So the whole 2,200 will be 1245 gain. Then all the losses are considered as section 1231. So this will be section 1231 ordinary loss. Now, if we talk about 9,000, this is a warehouse, which is a real property. So it will be having 1250 unrecaptured gain or recaptured gain. So unrecaptured gain for this is up to the 6,000 depreciation, if because this is a SLM method. So unrecaptured gain is 6,000, and recaptured will be 0 because SLM is equal to the accumulated depreciation. The depreciation we are calculating. So only we have unrecaptured gain 6,000, which will be calculated at 25%, and we have remaining $3,000 as 1231 gains. So here only $900 of 1,200 is ordinary income because recapture is the lesser of accumulated appreciation or gain, and balance is this. Then all of the 2,200 will be this, and no depreciation and unrecaptured depreciation will be there. Now, to calculate 1,231 total gain or losses, so we have 1,231 gains as well and losses as well. So for office equipment, we have 300 gain. Machinery, we neither have loss nor gain. Then we for 1,231, then delivery van we have 200 of loss, 2,000 of loss. Then warehouse we have $3,000 as capital gain or 1,231 gain. Plus we have we will also consider 6,000 unrecaptured 1,250 gain over here. So total of $9,300 and $2,000 of loss. Now the result will be section 1. So section 12545 gain will be uh, 1245 gains will be equal to $3,100. So $900 plus 2,200 equal to $3,100. 1,250 recaptured gain will be $0, and 1,231 gains are 9,300 minus 2,000 loss, that is 7,300. Wherein 6,000 unrecaptured gain, section 1,250 gain will be taxed at 25% tax rate, and balance 1,300 will be taxed at capital gain tax rate, that is 15%. So this is how we solve the or calculate the values of 1,245, 1,250, and 1,231 gains. And this is all about gains and losses from sale of long-term business assets. Thank you.